So take us through some of the data that we do have here. We're not comparing it to last year or 2020, for instance. We're bringing it back to the pre-pandemic era.
Yeah, and that's because the pandemic caused a lot of weird things to happen with the car industry. So basically, during the pandemic, a lot of lenders were more lenient. You also saw consumers have these stimulus checks and lower interest rates. So basically what happened is repossessions were, at a moderate level, then they dipped, and now they're climbing back up. And that really reflects the worsening status of the consumer and people kind of struggling to afford their monthly bills.
Is there a reason, though, why the car owners themselves, meaning, I'm sorry, the car companies themselves, or the finance companies, I should say, are being more aggressive than what they were? Why aren't they as forgiving as they were maybe 2 or 3 years ago?
A lot of that was due to just the pandemic in general,
right,
and a lot of leniency. We had leniency in student loans and another kind of debt. So basically that was sort of an anomaly, and now we're back to normal. We're back to, repossessors coming after cars when they're, people have missed about 3 months worth of payments.
I also wonder how much of it is tied to adjacent costs to owning a car. Like car insurance has gone up quite a bit. And Allstate CEO Tom Wilson has told Barron's that you'll see auto insurance prices continue to stay higher. They were up 16% in 2022, up 16% in 2023, and up 2.4% this year. But that's just the race that got approved. It does take, he says, up to 1.5 years for everything to ripple through.
Absolutely. There's insurance costs. It's not just your car payment. It's all these other things that go into owning a car. And not just that, it's the higher prices for everything. We know inflation is cooling, but it's still caused tight budgets. And so people are trying to balance all of their expenses, and car payments are kind of
parking costs, car wash costs.
But what about this notion, though, too? I mean, we talk about this idea that, if you are struggling to pay your bills, the car is one of the last things that you give up on, because a lot of people in this country are reliant. If you don't have a car, you're not going to go to work or go to school or other things here. Have we reached sort of a tipping point where things are that bad, where people just have no choice but to sort of allow these repos?
They're definitely getting worse. I mean, I think that is sort of what people have to weigh when they're deciding what bills to pay. In some cases, it's deciding between your house bill, your student loan bill, your auto bill. We do see that auto bills are pretty high on people's list of priorities, but it really depends on the person, I think. But yes, we do know that in so many parts of the country, you have to have a car to get to work. If you lose your car, you lose your job. So it's a huge priority.
So you're Bloomberg's personal finance reporter. What metric would you look to next to kind of follow along with car repossessions going up?
A big thing that I look at is some data from Fitch Ratings, and they do a great job of tracking the number of people that are at least 60 days behind on payments, especially with those subprime borrowers. Those are the people that are most at risk of having their cars repossessed. We saw that reach a record high in February. It's dipped slightly because of some seasonal factors, but I'm going to be watching that to see if it goes back up again.